Hello and welcome to a brand new episode of Smart Money. Today we're going to discuss hybrid funds, arbitrage funds, what the funds entail and why you should be looking at them in your portfolio. Our experts today are Dinesh Balachandran, who's the fund manager equity at SBI Mutual Fund, and Bhavesh Jain, who joins me here in the studio. He's the co-head of the hybrid solutions at Edelweiss Mutual Fund. So gentlemen, to both of you, thank you so much for joining us. And this is a very interesting time in the market, considering we're almost at all-time highs and there are several opportunities in the market to look at. So today we're going to talk about the hybrid category. So Bhavesh, let me start with you first for the benefit of our viewers, right? Yep. What are the funds that come under the hybrid category? And then we'll talk about what the opportunities are for retail investors.
Sure. First of all, thanks Sonia for having us here. You can say in the hybrid categories, there are different funds starting from arbitrage fund, then equity saving fund. We have multi-asset allocation fund. We have balance advantage fund. Then we have conservative hybrid and aggressive hybrid fund. So these are, you can say, 6 or 7 funds within the hybrid category.
Okay. Dinesh, welcome to the show. So Bhavesh has listed down all the different types of funds in the hybrid category. But from a retail investor standpoint, where do you see the opportunity now?
Yeah. When you think about it, sometimes it might appear a bit confusing when you have like so many types of funds. But at the core of it, what we are trying to do is essentially have funds that are tailored to an investor risk profile. Now, we all know that equities essentially represent one of the best wealth generation opportunities over the longer term, right? It probably beats every other asset class out there if you have a long enough time horizon. But the problem is many investors get worried when they see these periodic drawdowns that happen in equity markets. Think of COVID as an example, right? During COVID, you suddenly saw a big drawdown in equities and a lot of people got scared and probably redeemed money at the exact wrong time. And this is where a hybrid fund, there are various types of hybrid funds, but if I have to generalize, this is where hybrid funds come into the picture, where the thought process is that through a combination of equity, fixed income, and gold in certain cases, you essentially get to a risk profile which is probably much more stable compared to investing in a 100% equity fund. And this is where a lot of people essentially, particularly if they are new to the whole mutual fund space, they essentially get a lot of comfort that at the end of the day, the risk profile measured in terms of drawdowns or corrections is not going to be that high in these hybrid funds. And this is achieved through a combination of investing in equities, fixed income, and gold in certain cases.
Okay, so at a time, Dinesh, just to follow up here, at a time when the market is at all-time highs, when there's so much equity participation, for someone who has a relatively higher risk profile and is perhaps in the age bracket of 30 to 40, out of say 100 rupees of an investment that he's making, how much should be in pure equities and how much you consider should be in these hybrid funds?
Yeah, and no, frankly speaking, unfortunately, there is no, one solution for everyone, right? Because at the end of the day, it really boils down to what risk profile is that person comfortable with. Now, if someone truly believes in having a high risk profile and having a long enough time horizon, I would say that put all your money in equity funds because they are going to give you the most returns over a long enough time frame. But unfortunately, what we've seen is that a lot of people say that I have a high enough risk tolerance, but then when they actually see the correction, then they start panicking. And from that perspective, what we recommend is for many investors, have a core which is basically in the hybrid fund category. So call it like roughly 50% of your portfolio. 50% of your portfolio, you can essentially put in hybrid funds. These are supposed to be all-weather funds, which means that regardless of the exact market cycle, whether we are at the very peak or in mid-cycle or whatever it may be, you are probably going to generate returns much better than what you can get in a fixed deposit. I'm not saying that these funds are risk-free. They do carry risk, but the risk is definitely much lower than what you will see by investing in a pure equity fund.
Okay, got it. Bhavesh, after the indexation benefit removal, there was suddenly, a lot of attention, a lot of investor attraction that came into this category. Why do you think that is?
See, if you go back, the first change in debt taxation happened in 2014. Where NDA government in their first budget changed long-term capital gain tax of debt from from 1 year to 3 years. And that was the time where actually hybrid as a category picked up. At that point of time, all arbitrage fund together was close to 5,000 crore. Today, that is the 1 lakh crore category. All balance fund put together was close to 35,000 crore. Today, that is almost a 2 lakh to 2,50,000 crore category. And now with this latest change, which has happened in this March, we have again seen the second round of uptick in the category, wherein people are looking to park their 3-year plus money, wherein earlier they were getting indexation benefit, and now that with that benefit taken away, people are trying to find out different places where they can park this money in a much efficient taxation. And that is where hybrid as a category has started picking up. Those who are purely looking at pure, you can say, equal replacement are moving into arbitrage fund. That's why we have seen almost, say, 20,000, 25,000 crore of inflow into arbitrage fund in last 3 to 4 months. And those who are ready to take some risk are looking at fund like equity saving fund and balance advantage fund, wherein with some volatility they can get much better tax adjusted return over a 3 to 5 year time period.
Dinesh, comment on this, because I mean, there has been a lot of interest suddenly, right? If you look at the numbers, hybrid schemes have seen an inflow of over 14,000 crores just in the June quarter. I mean, this compares to an outflow in the preceding quarter. So is it purely because of the indexation benefits removal that you've seen this kind of money getting pumped in? And what do you see as the way forward over the next 1 to 2 years?
Yeah, definitely taxation does have a role to play. When you have essentially different taxation for different products, I think a lot of investors care about that. And from that perspective, it definitely has played a role. But more than that, what we are also witnessing is that there are many investors who historically have parked a significant part of their savings in FD-like products. And now they are realizing that you can essentially get much better returns without taking on like too much risk by investing in these hybrid funds. So from that perspective, there are a lot of first-time investors that we are seeing who are essentially slowly embarking their journey in the capital market space, and hybrid funds would be the perfect sort of stepping stone, so to speak, for a lot of these first-time investors.
Okay, so since we have a lot of first-time investors that watch our show, right, Bhavesh, for people who perhaps have never invested in hybrid schemes, what are the 2 or 3 reasons why they should do that, and how should they begin their journey?
Sure. So depending upon individual risk and return profile, one can look at different hybrid funds. Those who are very conservative and normally keep their money only into, say, bank account or maybe some liquid fund, they can start their journey with arbitrage fund, wherein everything is totally hedged. So even if Nifty goes up by 10-20% or goes down by 10-20%, they are not at a loss. They will keep on getting a better tax adjusted return compared to what they get in their saving account or maybe in their other fixed income fund. Those who are ready to take some risk, I think the first time investor, they should come into equity market purely into a fund like, say, balance advantage fund or an equity saving fund, wherein a 3-year, 5-year down the line, he will get, you can say, a reasonable return, better than what normally a client will get in his fixed deposit or other, you can say, fixed income product with minimum volatility. I will not say that there is no volatility or no risk. There is risk, there is volatility, but compared to a pure equity fund, hybrid fund manages volatility in a much better way.
Okay. Dinesh, the hybrid funds since they invest both in equity and in debt schemes, right? One complaint is that there's a higher expense ratio compared to just investing in a pure debt fund. So if I anyway want to invest in both equities and debt, I invest in a pure equity fund and a pure debt fund, hence pay less expense ratio. But now with hybrid funds, the expense ratio is higher. You want to address that concern?
Yeah, I think where hybrid funds really come into the picture as a solution is the asset allocation part. Now, it's right. Someone can potentially sort of park part of their money in equity funds and remaining part of their money in debt funds. And potentially speaking, they should replicate what we are trying to do here, right? But the question is, how are you going to change asset allocation? Do you have a systematic way of changing asset allocation? And this is where a lot of people essentially sort of have problems. And this is where the hybrid funds as a solution really comes in. Because our job, number one job here, is to get asset allocation broadly right. Which means that when the odds are in favor of equities, when valuations are low and there is a lot of pessimism, we want to increase allocation to equities. And when we are at the other end of the spectrum, we actually want to reduce our allocation to equities and park more of the money in fixed income. And this is the job that we are trying to do, where we are trying to do in a systematic fashion. And what we've seen is the battle is more than half won if you are just doing it in a systematic way. It doesn't matter, frankly speaking, in terms of what exact approach you're using, as long as you're doing it in a systematic manner. And what we've seen is that for many investors, they don't have a systematic way of changing this asset allocation. And that is where the hybrid funds as a solution definitely comes in.
Okay, well, we have to take a short break. Both of you do, manage large hybrid funds. So after the break, I'm going to talk to you about that. Don't go anywhere. We'll be back in just a bit on Smart Money.
Anand